Today, the art of credit creation. Hello again, I'm Martin North, the Principal Analyst of Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Today, I want to discuss how banks lend and why the idea that bank deposits limit bank lending is plain wrong, and helps to explain why home prices have exploded in recent years. And by the way, if you get value from our posts, please do consider supporting our work either via Patreon, here is a link, or by making a one-off donation via PayPal. Again, here is a link. We really appreciate your support to help us continue to make great content. Home prices are horribly high in Australia. I think we can all agree about that. The latest affordability data from Demographia, which we discussed in an earlier post, housing affordability is still in the doldrums, showed that in Australia most markets are severely unaffordable. But the question is, what is really driving this? Classic economic theory is that supply and demand of property drives prices. So factors such as the number of new buildings, population and migration and planning controls are all to blame. Indeed, a recent paper from the RBA peddled that line, as does the property and real estate sector. State and federal governments also talk this up. Even Demographia blames planning controls. But there is another factor which is, according to our simulations, much more directly impacting home prices, and that is the availability of credit. Indeed, our predictions for home price falls, which have proved to be very accurate in recent times, is driven by the so-called credit impulse, the rate of change of credit availability. And even now, the annual growth rate in credit is close to 5% for home purchase purposes. But it has been falling over the past few months, thanks to tighter lending standards and less demand for credit from property investors. But the idea that credit supply is the main driver of home price momentum is contentious, because classic economists, including those residing in most central banks, tend to argue that credit growth is a zero-sum game, in that if there is a loan on one side of the ledger, then there is a creditor on the other side of the fence, so the net impact is zero. Worse still, classic theory suggests that banks are limited by what they can lend by the availability of deposits through the so-called fractional reserve system. But neither of these statements is true, and so it fundamentally changes the banking and banking supervision game. Back in 2014, I discussed this based on an insight from the Bank of England. Their quarterly bulletin in 2014, the first quarter, was revolutionary and has the potential to rewrite economics. Money creation in the modern economy, it was called. And it turns things on their head, because rather than the normal assumption that money starts with deposits to banks, who lends them out at a turn, they argue that money is created mainly by commercial banks making loans. The demand for deposits follows. Rather than banks receiving deposits when households save and then lending them out, bank lending creates deposits. And more recently, the Bank of Norway confirmed this and said the bank does not transfer the money from someone else's bank account or from a vault full of money. The money lent to you by the bank has been created by the bank itself out of nothing. Fiat, let it become. And even the arch-conservative German Bundesbank said back in 2017, this means that banks can create book money just by making an accounting entry, according to the Bundesbank economists. This refutes a popular misconception that banks act simply as intermediaries at the time of lending, i.e., that banks can only grant credit using funds placed with them previously as deposits by other customers. But this means that the only limit on the amount of credit is people's ability to service the loans eventually. The more banks lend, the bigger they can become without limit. And as banks issue bonds and other securities in international financial markets to balance the books, their capacity is only limited by the availability of liquidity, investors willing to lend, and firms and households willing to borrow. And as we've seen recently, rises in international funding costs require banks to pass on higher rates to borrowers to preserve their margins, as the BBSW rate shows. In fact, our calculations suggest that there is another 50 basis points of margin to be recovered. But remember this, Credit availability drives home prices. Now, with that in mind, we've built a scenario model based on our core market model, which allows us to test the relationships between home prices and a series of drivers, including population, migration, planning restrictions, the cash rate, income, tax incentives, and credit. And we're looking at national averages here, and we've soothed the data from the RBA and the ABS to bring the trends out. And as we discussed in a post last year, popping the housing affordability myth, we mapped the various drivers to home prices. We showed that income growth and home prices are running in opposite directions, and has been especially the case since 2013. So income growth is not correlated to home price growth. Then we looked at home price relative to migration. And once again, there is little alignment between home price growth and migration rates. This despite up to 2/3 of population growth being fed from migration in recent years. We also showed that the relationship between overall population growth and home prices is equally disconnected. For example, the rate of growth slowed from 2012 onward when we had a large run-up in home prices. The same is true if we look at building approvals, and even adjusting for the delay between approvals and commencements, there is little correlation. Up next is the Rba Cash Rate, and we found that as interest rates are cut, home prices expand. This also suggests that should rates rise, home prices will fall. And here is the reason. The correlation between home prices and credit availability are clear to see. We've updated this chart to take account of 2018 data. And as credit rose from 2012 onwards, home prices did too. It also suggests that if credit availability is tightened, we should expect prices to fall. Take note, given the current tighter underwriting standards now in force. And this is why I predict further ongoing falls in property prices. And more specifically, credit for property investment is even more strongly correlated. As we know, investors are attracted by the capital growth and also the capital gains and negative gearing tax breaks, which are available for now. What's more interesting is the relative weight of these different factors in driving home price movements. The four most powerful levers in terms of home prices is first, overall growth in personal credit, including mortgages and other loans, at 27% of total impact. Investment lending contributed a further 18%, followed by tax policy for investment property at 17% and the cash rate at 14%. The other factors, the ones which are spoken about the most, property supply, population growth, planning restrictions and migration together make up just 22% of total impact. Or, in other words, without addressing the credit elephant in the room, tax policy and interest rates, the chances of taming prices is low. First-time buyer incentives, by the way, were less than 1%. So the greatest of all these is credit policy, which has for years allowed banks to magic money from thin air to lend to borrowers, to drive up home prices, to inflate the bank's balance sheet, to lend more, to drive prices higher, repeat ad nauseum. Totally unproductive, and in fact it sucks the air out of the real economy and money directly out of punters' wages, but makes bankers and their shareholders richer. Plus, the second-order impacts to the construction sector also follow on from that. And two final observations. First, the GDP calculation we use in Australia is flattered by housing growth triggered by credit growth and construction activity. And the second driver of GDP growth is population growth. But in real terms, neither of these are really creating true economic value, as seen in the per capita data. Second, the capital regulatory framework from the Bank for International Settlements is still a hangover from the days when deposits were thought to drive loans, so holding a ratio of assets to protect deposits made sense. But given the multiplier effect available to banks via their ability to issue bonds and the like to increase their loan books, the BIS rules as currently formulated are ineffective. In fact, by applying low risk weights to mortgage loans, they encourage banks to leverage up even more. And in Australia, our major banks have only about 5% of shareholder capital at risk. This is way too low. So to conclude, to solve the property equation and the economic future of the country, we have to address credit. But then again, I refer to the fact that most economists still think credit is unimportant in macroeconomic terms. The alternative is to continue to let credit grow well above wages and lift the already heavy debt burden even higher. In fact, some are calling for a reversal of recent credit tightening to resurrect home price growth. But that is ultimately unsustainable, and why there will be an economic correction in Australia, and quite soon. If you found this useful, please do like the post and add a comment or question. I read them all. And if you have already subscribed, many thanks. I really appreciate your support and participation. But if you have yet to subscribe, please do so now to receive future alerts. I'm Martin North, the Principal Analyst at Digital Finance Analytics. Many thanks for watching, and I'll see you next time.